You know, from basically doing this and thinking about it for 30 years, I wanted to summarize really what I thought were, you know, what's important. And so, and it may seem a little bit simplistic and a bit obvious, but I can tell you from my experience that, you know, a lot of investors lose sight of these things. So, you know, the first thing is that the first principle is that valuations matter. That the price you pay for something is the biggest determinant into future rates of return. And, you know, if you overpay for something and you run the risk that it will go to fair value, and then to go from fair value then to outperform the market after having been overvalued is a really, really painful process. If you buy something that is, you know, really cheap, it's undervalued, you know, you always have the potential that it could go to fair value, which means that you have that little extra oomph. So valuations are the most, so we're very, very, you know, keen on valuations. The second thing is that we think reversion to the mean is the most powerful force in finance. So you look at gold, which is up six-fold or so in the last 10 years, and the markets have done nothing. To us as long-term investors, you know, that's telling us something. So we do that, you know, between asset classes, but also within asset classes. So if we decide we have to own a beverage company, then, for example, we would look at Coke and Pepsi and see that historically over time, maybe Coke is cheaper than Pepsi or vice versa. That may lead us to buy Pepsi versus Coke, for example. The third most powerful, but the real way that we use reversion to the mean analysis as a practical matter is in relation to itself. So if we're looking at a blue chip company that's been around for 100 years, 200 years, and it's been consistently profitable, you know, take a Johnson & Johnson right now, trading at 12 times earnings, you know, 10, 12 years ago it was 30 times earnings, you know, whereas historically people say, well, 15 or 16 times earnings. So we like buying blue chips at 12 times earnings if historically they've traded at 15, because, you know, if they have, you know, bozos as managers right now, if they're big, powerful companies with a decent corporate governance, then the bozos will be gotten rid of. They'll bring in some competent people, and then you'll revert back to that mean and get that extra. And if the company's paying a good dividend while you wait, to us it's like, you know, that's a good thing. The third enduring principle is volatility is not the same thing as risk. We explain what volatility is it's the price you pay for liquidity. Risk is the potential for permanent loss of capital. So, as Benjamin Graham said, you know, truly risk is that the world changes and the business model doesn't comport to that change. So, you know, when I was a rookie broker, people would say, you know, back in 1893, you could have owned the best buggy whip manufacturer out there with great financials, but you had been screwed, and they're absolutely right, right? So we're constantly thinking about, is this, what this company does for a living, is it of an enduring value that human beings will need or want for the indefinite future? So volatility is not the same thing as risk. The fourth thing is that careful investment selection trumps random diversification. So we believe that if you have 20 to 30 really, really, you know, great businesses that you know, that gives you enough diversification, as opposed to what these big money management latifundias are telling you, that you have to own, you know, 20 different ETFs owning a million different, you know, individual securities. And then the final thing is that dividends matter. Dividends matter because 40% of the return in the U.S. stock market is from dividends. Dividends matter because, you know, cash can't be made up. And if you look at some of the big scams or some of the big controversial stocks over the past decade or so, you know, WorldCom, Enron, you know, they didn't pay a dividend. They also didn't have positive cash flow. But so dividends matter. So we like, so those are the 5 enduring principles that we kind of frame everything